In today's video, we are going to take a look at another example where the alignment of the Andrews pitchfork and some lines with contextual market analysis will provide a simple and yet powerful way of picking the reversal points in the market with very good accuracy. The first thing that catches the eye in this first part of the analysis is the fact that price created a major down vector, and now it's testing the resistance left by a minor low that was left a few moments before the major down vector began. Notice how price attempts to violate that horizontal level and it fails to do so. One interesting detail here is that the barrier created by minor sellers is being able to block the action of major buyers. The major down vector has terminated, and now buyers are in their turn to create a major up vector, so to speak. Observe that the market has a much easier time going down than going up. That should give you a very good indication about the underlying selling pressure in this market. Sellers have a much easier time than buyers. Notice also that in the major up vector that we can also call a retracement attempt, buyers in the minor dimension are creating higher lows, but because of the horizontal line of sellers, they are not being able to create higher highs. In other words, even though buyers are desperately attempting to prove their ground on the minor flow, they are being held by the sellers. That is extremely clear in this market. Notice that we can draw a line connecting the lows that represent the origin of each attempt of the buyers. Here I have to clarify something about what you're seeing on the chart. Many people attempt to trade something like this using the framework of pre-established price patterns. This would be classified as a triangle. Even though I believe you should understand these patterns, I believe they are unreliable for the most part because they are abrupt oversimplifications. There are much more sophisticated and accurate ways of trading as I'm trying to show you here in this video. I say that because one of the ways to trade a price pattern like this is when price finally breaks out of the geometric figure. Notice that when that happens, price is far away from any market edge, and that's the fundamental problem. Since price is far away from any real market edge, it logically follows that the correct stop loss placement is also too far away. A large stop means a large target that is much harder to hit. If you try to correct that problem by using a cash stop loss, you'll be shooting yourself in the foot because cash stops are irrational and much more likely to be hit than logical stops placed grounded on market context. The correct thing to do when price breaks out of the triangle pattern, even though I simply like to observe price in relation to lines without trying to fit a geometric figure to make it easier, is to see that as a confirmation of the downward momentum of the market, as I have been talking before. We had pieces of evidence that this was supposed to happen if we look at the contrast between buying and selling pressure in this market. From this point of confirmation, we can start fine-tuning the analysis to see if we can enter this market in a point that provides the necessary operational conditions. In other words, we have a good idea about the bias or direction of the market. That's already something extremely important. Now we can employ the line work to find the edges of this market without trying to jump on the bandwagon like we would do if we were simply trying to trade simple geometric price patterns. With that in mind, we can draw a pitchfork in the major price vectors of this market. By doing that, we immediately see that the standard pitchfork is out of sync with the market just by looking at its angle. Overly steep pitchforks need to be corrected by modification. In other words, the pitchfork will tend to enter the same frequency of price when we turn it into a modified shift for reasons that are beyond the capacity of this video. When we modify the pitchfork, we can see the difference immediately. The first thing that catches our attention is how perfectly the pitchfork catches the lowest low in the chart, just by using the two major vectors in the top of the chart. That would take care of a target in a situation like this. If we were to talk about the entry, we could still use this pitchfork and some parallel lines to catch the edges of the minor flow near the center line. Notice that the pitchfork implies that the market is tilted to the downside, so it makes perfect sense to look for tilted support and resistance lines as well. We can do that by mimicking the angle of the pitchfork and then plotting a line in the lower frequency of the minor flow near the center line. Notice how this line is able to catch the low frequency and then project a high frequency a few bars later. This is the sort of analysis that will enable you to find the correct market edges, with the correct bias, with the correct places to put a stop loss and target order. If you want to learn how to analyze the market in a professional way, check out the courses available in the video description. If you enter my website, fractalflowpro.com, you'll be able to see the table of contents of each course and a large list of YouTube verified testimonials from students all over the world. If you like this sort of video and wish to support the channel, please click the like button, subscribe to the channel, and leave your feedback below in the comment section. Thank you very much for watching, and I hope to see you in the next video.